Hey there, and welcome to the show today. I am your host, Michael Blanc. I am excited that you're here. Today, we're going to shine the light on passive investing because, maybe you've actually been successful at saving some money in your life, and you're trying to figure out what to do with it, right? So you traditionally gave it to your financial advisors. They've invested it, and you're up 20%, then you're only up 10%, then you're down 20% the next year, and you're like, my gosh, am I actually making money? Meanwhile, your stockbrokers are making fees every single time. Every time you sell something, you have to pay taxes on it, right? So it's very frustrating, even from my own experience before having gotten into multifamily, is how do I make reliable financial projections? And it's really hard to do. And we saw in 2008 where so many people's retirement funds were wiped out. Now, if you're younger, you've been able to bounce back. But if you're old at the time, this was a serious problem with you. And so the question really becomes, is the dream of retirement just a dream? Is it possible to actually retire early? And today we're going to talk about that. We're going to talk about that because, in fact, it is not just a dream, because you can actually retire early and you can do it in your lifetime. In fact, you can do it in just a handful of years. And we've shed the light on this now, a few podcast episodes. We're going to do it again. So we're going to actually, our guest has done it, okay? So we're not just making the stuff. He's actually done it, and he's proven that it can be done. And we're going to talk to him about how exactly he did it, because he's not a multimillionaire. And how was he able, within a short number of years, quit his job with passively investing? So let's stick around. Let's do this. So make sure that you follow me on Facebook and Instagram. I'm the Michael Blanc on both Facebook and Instagram. All right, so make sure you follow me there. In fact, we actually have 8,000 followers on the Facebook platform. We also have about 6,000 in our private Facebook group. So you may not know about this, but it's called the Apartment Investor Network. So go to Facebook, search for Apartment Investor Network, and submit. It is a private, so we do screen. You have to answer a few questions. If you don't answer them, you don't get in. Sorry. If you behave badly, we're going to kick you out. And it's just one of those that's super active, super excited about that. We have about 6,000 people in there. So check that out, Apartment Investor Network. All right, on to our show here. We have Travis Watts on the show. Travis is a full-time passive investor. Now, as I said earlier, we've been highlighting this a little bit over the last few episodes, over the last 4 months or so. We have the last one in episode 186, so it's themichaelblanc.com/session 186, or 186 for short, with Spencer Hilligoss. Session 181, we've had Jan Larson, and then 174, Ryan McKenna. So 186, 181, 174 are the ones that we have, where what I really want to do is I want to show you how it's possible to literally have financial freedom by passively investing. Because I got to be honest with you, when you do have some money to invest, right, actually investing it passively is darn near equivalent to investing it actively, right? So if you have money to invest, really question whether you want to invest it actively, because there's a lot of work and responsibility and headaches that you have when you're actually the sponsor. So investing passively is super exciting, and a super way to literally quit your job. And Travis is a perfect example of that. He's now a full-time investor. He's actually investor relations with Ashroff Capital, which my good friend Joe Farrell is heading up. So really cool to get to talk with him about that before. And he's all about what he calls time freedom. And I call that financial freedom, because financial freedom is a predecessor for having your time back. So we're really saying the same thing. But what's cool about him is, he didn't inherit a bunch of money. He wasn't a millionaire. He was just, working like everybody else. And what he did very well was he maintained a lifestyle, and he didn't expand his lifestyle beyond what that he was making. And this allowed him to have some investments. Now, when he first got started, he didn't have a lot of money. And he got started with single-family house investing, like so many people do. And he kind of caught the bug until he finally realized that this single-family house investing, man, it's kind of active, right? It was kind of active investing. If you're a landlord, you know exactly what I'm talking about. And he's scratching his head after a while going, there's got to be something better. And that better is, of course, investing passively in multifamily syndications. So he's going to talk about what his first real estate investment was and why that really wasn't the ideal investment for him at all, and how he's been able to get started at all? How is he able to save some money, and what do you do with it? I asked him about his last day in a job. That was kind of fun because that was a real thing for him. We talked a lot about how to vet sponsors because this is an important thing. You don't need a dozen sponsors, you need two or three, but how do you really evaluate those sponsors so you know who to invest with? His biggest aha moment and any advice that he has for you guys watching and listening to this. You've got some money to invest. What do you do with it? How do you go about it? And something that you can actually do just like he did, which is quit his job. And he did it within like 4 years or something like that. So it's super, super awesome. Let's get right in the show here with Travis Watts. Here we go. Travis, welcome to the show today.
Thanks for having me, Michael.
It's awesome to have you today. You know, we're starting to shine a light on passive investors who are literally full-time quit their jobs, right? It's a thing. And you had a pretty demanding job in the oil industry, working a lot of hours, traveling a lot, and you were able to leave that job due to the income you were earning from passive investing. I was going to ask you, Travis, describe to me your last day at work.
Oh, man. That was an interesting one. So kind of the backstory there is I was in Colorado and I was working locally. And so that entailed, very cold winters, sub-zero temperatures, 14 hours a day outside. It was terrible. And so I took this approach to go work in the Middle East. So then I went to the other extreme, right? It's 120 degrees now, sweating my butt off, and that's also miserable. So this was I kind of saw this oil downturn that had happened and kind of saw the writing on the wall of what could happen. And I was actually already ready to make the leap into quitting that job. And that just kind of gave me the kick in the butt to actually do it. So it actually resulted in a layoff, which was much needed in my case. And I was actually thrilled to get the call when they said, don't worry about coming back. I thought, okay, I'm excited now.
It sounds to me at that point, you already had significant income from your investments at that point.
That's right. Yep. I had already become financially independent through cash flow, specifically through real estate. And I was just not really knowing which path I wanted to take from there and just kind of taking my time deciding. And I just needed that kick in the butt to get started.
That's interesting. Why are you hemming and hawing over that?
I guess I didn't ever set out necessarily to achieve that goal. It came a little quicker than I had anticipated. And when it was there, I was kind of caught a little unprepared. What do you do when you're a younger individual and you don't necessarily want to quote unquote retire, as far as I don't want to work anymore for the rest of my life? I didn't know what to do really. So I had a job that was, high income. And I thought, well, I'll just park here for a while, I guess, till I figure it out. And then, getting laid off gave me that push to really soul search and figure out what I was going to do.
I think retirement is a myth. Like, who actually wants to retire? Like, that's the dumbest thing I've ever heard.
It kind of is. And why does it have to be at age 65, or 59 and a half? I mean, everyone sets these benchmarks, but they're kind of artificial. Why does it have to be that way?
Right. So it's not retirement we want. What is it? I think it's just we want to be able to control our time, right? I mean, that's what is, I don't know. What was it for you?
Well, I refer to it as time freedom. Yeah.
Yeah.
The ability to do what you want, when you want, with your time. I mean, if nothing else, it gives you options, right? I mean, and so for me, it gave me an option to the job I didn't like, the job that was like literally taking my life away. I was away from home and I was working way too much. I had now the option to say, you know what, I don't have to do that. I can take on a job that pays half as much that I learn 10 times as much from. Yeah.
Now, you still work hard now, but what's different than working hard before? Like, how is your life different now than it was back in the heyday?
Yeah, I think when I think of work, quote unquote, or hours put into a project, the difference is mentally, I was completely unhappy doing what I used to do as a W-2 employee working the oil field. I felt like a big mismatch in that industry. It just didn't fit me. I didn't like manual labor. I didn't like working outside, yet I was doing all those things. So every day was a struggle, right? Just to get up and show up. I just hated that process. And so the difference is once I quit that, due to passive income, I could then pursue things I was actually interested in, things that I would personally grow from. And for everybody, that's different. It might be charity or more church, volunteer, travel, or, for me, it was just keep on plugging away, but make it a personal growth journey and not just, oh, I have this job because it pays pretty well.
Okay. Well, so what does that mean for you? A personal growth journey. What does that mean?
Yeah. So the first thing I was getting involved with more and more was apartment syndications and being truly a passive investor. I wanted to learn more and more about that. And yes, there's the podcasts, of course, obviously like this, and there's books, and you could get a mentor. But what I really wanted was more hands-on. I didn't want to do my own deal per se. I just wanted to be like an insider to understand how this all works day to day. So that's the first thing I did. I'm sorry. The first thing I did is I went to go work for a brokerage firm actually to learn Wall Street investing and see how that compared to what I was doing in real estate. Once I realized I didn't want to do that, then I had the flexibility to leave that to go work for a syndication group. And then I could start learning how they, underwrite and acquisition and the whole process. And so even today, I affiliate with Ashcroft Capital, so Joe Fairless's group, and investor relations. All I really do is I network and I talk to people about investing and multifamily and passive income. And I just love that process. I do it for free.
Yeah. So what is your, I'm going back to your quitting your job. What did your coworkers think, or your family and friends? Like, what was their reaction?
I mean, I don't think a lot of people in the mentality that I worked around could really grasp the concept of having enough passive income to quit their job. I think 99% of them would have taken that option had they known it was an option. What I really saw, though, was poor spending habits, poor budgeting. So we all made the same amount. But at the end of the day, a lot of those guys that got laid off at the same time I did had nothing to resort to and had to scramble and just, had to hit the ground running to find some kind of income source, where I had built up that flexibility by saving most of my money that I made.
And so what did you do? I mean, that's a good point, because especially in our culture, the more money we make, the more money we spend. How did you resist that in some way?
I was brought up very conservative by a couple parents that were extreme budgeters. And, if it wasn't on sale or off brand, or we didn't have a coupon, we didn't buy it. And that's how that went. And so I was just kind of raised that way. I always had an awareness of, if all I had was $100, I needed to be very wise with that and make that last as long as I could. And in college, I did some extreme budgeting things. I would do $2 a meal, 3 meals a day and no more. So I spent $6 a day on food. And, I always kind of had that ingrained in me. So at the time where I went from making at some of my entry level jobs, like say 20,000 a year, to making 6 figures, I didn't really change my lifestyle, right? So I still lived on the bare bones minimum for many years. I took all that savings and I invested that into real estate. So that helped propel that process.
Do you have family?
I'm sorry?
Do you have a family?
No kids yet. No.
Okay. That's good. Sometimes they make that a little more difficult, but I think
Agreed.
That's great, because not a lot of people do that, right? They just expand their lifestyle. And so the fact that you're saving has already set you apart from a lot of other people. I think the other thing, though, is, so people who do save, like, what do they do with their money? What were you doing with your money before you started investing in multifamily?
Yep. Good question. I did start, I guess you could say, investing or real estate with single family. And so, I literally started just with buying myself a home. It was pretty much coincidence that it happened to be 2009. I saw the housing prices dropping, rapidly. The government was giving out the $8,000 first-time home buyer tax credit. So it's kind of this combination of, I had read a couple books, I'd seen my dad do a little bit of single family, and then there was that opportunity. And since I had saved a little bit, I think I started with maybe 20,000 total, which, I'd been working since I was like 14 or 15. So, it accumulated over time. I was able to make that first investment, right? I lived in the home. I ended up renting rooms out of the home, doing like a house hacking strategy. It was next to a college campus. So I ended up having a couple roommates over time. And anyway, it just kind of evolved, right? As I started seeing passive income, cash flows, something I didn't have to work for. And at the time I wasn't earning much as far as wages go. And that made a huge impact in my life at that time, in ratio or as a percentage to my income.
So did you ever invest in the stock market, or was this house like literally your first investment?
Yeah, so my parents had set aside what they could for me for college, and they'd put that all into mutual funds, basically in a brokerage account. Um, that got a little bit hit through the downturn, but also, which is kind of totally ironic and weird, my dad had given me Rich Dad Prophecy. Most people start with Rich Dad Poor Dad. That's kind of their gateway book into real estate. This was Rich Dad Prophecy. All I really took away from that book was we're going to have a huge stock market collapse.
Yeah.
Don't know when, don't know what that's going to look like. It's going to happen. And so I got freaked out and I sold the majority of that, not knowing what else to do with it, but just thought, well, I don't want to lose it, right? That's all I knew. And so I sat mostly in cash through the downturn, and I was able to, you know, to keep the majority of that anyway.
That book paid for itself. So that's pretty cool. So, so you get into this house and you house hacked it, and you had some tenants living in the house along with you. Is that right?
Yep. That's right. Yep.
And then what did you do from there? Was that what investment did you make after that? How did that turn out?
So at that point, I really decided I wanted to pursue real estate like more professionally, more seriously. I really wanted to do this. And I had moved out of that house and rented it to two separate tenants. And I rented it fully furnished to get the maximum rent that I could, and bought another home and kind of did a rinse and repeat type of process for a while. It was during that time that I knew what I was earning as far as my W-2 was never going to suffice to what I wanted to accomplish in real estate. So I went seeking a high paying job. Hence why I got involved with the oil industry. It was about the only opportunity where I could make a very solid income locally. So I just took what I could get basically. And that's where that evolved. And I kept saving and putting it into single family at the time.
So you were just buying and holding.
Yeah, so I did buy and hold. I would do, I still call it a fix and flip, but basically buy a distressed property, fix it up, maybe rent it for a little while, like up to 12 months for tax reasons, and then I would sell it. So kind of a longer, I'm sure there's a name for that strategy. But so I did that. And then I eventually got into vacation rentals in the single family realm in Denver. And at that point, it was really becoming a job for me between the fix and flips, the buy and holds, and the vacation rentals. It's like, you know, here I am working 100 hours a week, W-2, and now I got this portfolio I'm having to manage. I'm having to pull in my friends and family, my girlfriend at the time, which is now my wife, saying, can you go collect that rent check? Can you go fix that sprinkler head? I'll give you $100, you know, and then I got a property management company, and I felt like it just increased my workload even more. And I thought, man, this is not scalable. It's not sustainable. And it's certainly not passive. And that's really what I wanted, was the passive income from the very beginning. I just went about it the wrong way.
Right. Exactly. Okay. So what did you do to fix that?
So I kind of went back to the drawing board. It was a rough time for me, really, because I was away from home. I was overseas. I felt like I was getting in over my head with this single family stuff. So I had everything in my head, from quit real estate, go into the stock market, do something different to make it passive, all the way from, you know, someone out there is doing this in a passive way. They have to be. How do these gurus and these big moguls, right? How are they passive? It doesn't make sense. So I kind of went back to the drawing board to do podcasts, books, real estate meetups when I was home, things like that, to figure out how to make something like this passive. And I kept hearing the word syndication from various people. Have you heard of syndication? Have you tried syndication? You should consider this. I had no idea what that meant at the time. So I started doing my research, figured out it seemed on the surface to be exactly what I wanted, but it seemed honestly a little too good to be true. And I thought, and I'm looking at some pro formas and I'm thinking, wait a second, I could potentially make more money doing that than I'm doing actively. And I thought, there's no way, that's not possible. Yeah. Well, anyway, so I did one syndication locally, and that's how I got started. And I was skeptical, and I sat back about 6 months and I watched the distributions start coming in, and I watched the monthly reporting start coming in, and I started to have that like epiphany, that aha moment of like, this could actually be scalable and sustainable, and it literally is passive. And so that put me on a whole different trajectory.
So in your mind, when you were testing this out, obviously you're like, oh, let me try it. And in your mind, when you started seeing the pro formas and you saw some of the distribution checks come in, did you do any kind of financial projections at all? And if so, what were they?
I think in the beginning, One mistake I would say that I made is putting way too much emphasis on a pro forma and not on the group behind the deal
Okay.
and what their track record is and what their experience is and how big their team is and their network. And I was just simply looking at deals going, well, this one's 10%, this one's 8. Well, I'm going to go with 10,
Yeah,
right?
yeah,
I mean,
right.
that makes more sense. And so, I probably made a few investments there that in hindsight I wouldn't have made. And as far as projections go, different people follow different models. I don't know if you're familiar with the FIRE movement, which is financial independence, retire early, but common formula that
Very
people,
extreme though, isn't it?
it can be. It's typically centered around people who have high wage earners that
Mm.
stock away a lot, kind of like I did, to essentially retire early or have that financial freedom as quick as possible
Yeah.
and live below your means and all that. So a common rule that folks in that movement follow is the 4% rule. So I mean, you can say, okay, I want 30,000 a year passive income. So you take that 30,000 times 25, and that's how much you need invested at 4% to get that outcome. So it'd be like 750,000, I think. And so, you could follow something like that, makes it pretty streamlined, it's fairly conservative, but that's just one guide. You can use your own numbers and base that off 8% or 6 or whatever, but start getting too aggressive and maybe you're getting a little outside reality that some investments aren't going to do what you hope. And, you may lose money along the way, making some bad investments, things like that. So 4% might be a good rule for some, but I don't know what I was doing back then. I think I was probably just looking at a pro forma saying, wow, that's going to be 10% for the next 5 years. That sounds good.
Have you tracked it all and try to calculate average annual return or anything like that?
Yeah. I mean, the majority of the deals I've done did the pro forma. I mean, they met the expectations. Some exceeded, a couple of them fell slightly below, and a couple are still in the works. So,
Yeah.
To be determined. But between my wife and I, we've done probably 25 different passive deals, in syndications of different sorts, mostly multifamily. But yeah, most of, we try to invest with good teams with track records and who can pull off these business plans. So far, so good.
I want to get your thoughts on that because that's really, really important. Before we do that, though, some of the numbers of someone listening to this, they're like, "What kind of income can I generate doing
Mm-hmm.
this?" Can you give people an idea?
Yeah, I think what's important first to look at is what your core beliefs are as far as your investment philosophy. So which markets do you want to be in? What type of investing do you want to do? Some people love new development. Some people love C-class, affordable workforce housing, things like that. I tend to invest in B-class multifamily. These are apartment buildings from the 1980s, 1990s, and usually with like a value add component to them. So you're going to, increase rents over time by making the community a better place. So it's kind of a win-win. Just ballpark numbers, I think it's still realistic to expect somewhere between maybe a 7 to 10% a year cash flow if the business plan is properly executed. And then in most cases, you're participating in any equity upside down the road upon the disposition or sale or refinance. So that could bring those numbers potentially higher, maybe 50% higher, maybe 100% higher. It just depends on the business plan. So it's a nice double-digit potential return that I personally find pretty conservative, all things considered, pretty recession resistant, if you will.
Recession resistant, double-digit return, consistent,
Yep.
cash flow, part pre-depreciation.
Yep.
And what about the taxes on this? Because that's all concern is
Mm-hmm.
capital gains.
Yeah, exactly. So the good thing is with most deals and pretty much every deal that we've taken part in, you have flow through depreciation, right? And with multifamily, it may make a lot of sense to do a cost segregation and to capture some bonus depreciation and things like that. Those are just paper losses that are going to flow through to the investors. So just to paint that as simply as I can, if let's say, as an example, you receive $10,000 for the year in distributions and cash flow. On paper, when you go to do your taxes, you may have a negative 20,000 loss, quote unquote, right? It's not a real loss, but in other words, all that 10,000 was tax-free while you received it. And then, yes, there's capital gains upon sale. I think the idea there is that, you potentially will have enough positive gains at the end to offset any tax obligation you may have. And then, of course, you could look into maybe doing a 1031 option or something like that, if applicable for you at that time. So there's ways to continue deferring taxes. But
Okay. Is
yeah,
a 1031, is that even an option with a syndication, or in most cases not?
I would say most cases not, but it is possible. Yes, there are groups that do accommodate to it. So my thing with that is it's so much easier to do a 1031 on a single family home. It just is. And then, because at the end of a syndication, you're going to have to find a deal, first of all, that makes sense to you. Secondly, they're going to have to accommodate a 1031 without a big threshold, like $1 million minimum or something. And then, it's just harder and harder to find. To make that sustainable over a lifetime, I think would be very difficult personally, but who knows?
Now, what role does, for example, sales and refinance play into this picture, right? Because there's a cash on cash return, 7 to 10%,
Yep.
but then there's also liquidity events.
Mm-hmm.
And to what degree do you rely on those, or what effect does that have on your overall returns?
Yeah, so it's kind of these types of investments we're talking about are, like you said, they're twofold. So there's the cash flow element, and there's the monthly distributions or the quarterly distributions in most cases. And then there's like years later. So let's look 5 years down the road. Maybe we're going to sell the property or do a refinance or something like that. So me personally, I'm a cash flow investor. My number one focus, and 90% of my focus, is on the cash flow projections. If the equity happens to be there, that's amazing. But, to look at a pro forma and say it's going to probably be a 30% bump 5 years from now, I take it with a grain of salt. Who knows? Maybe it's there, maybe it's not. So different for everyone. I wouldn't put too much emphasis on the 5 years down the road, what the world looks like.
Now, explain to people how the refinance works as a passive investor, right? Because that does have an effect on your cash on cash return.
Mm-hmm.
And what is the impact to you of a refinance?
Yeah, so there's different models out there. I'd say a lot of groups focus on this 5-year model of we're going to buy it, we're going to fix it up, we're going to increase rents, we're going to get occupancy up, and then we're going to sell it. That's probably the most common model in apartment syndication. However, there are groups that we invest with, that you can also invest with, that have more of an infinite return type of model. So they're going to buy it, fix it up, increase occupancy and rents, and then go to refinance so that they can send back whatever capital you initially invested, or as much of that as possible as you go along, to the point where, let's say you'd put in 50,000 from day one. 5 years down the road, you have that 50,000 back because of 1 or 2 refinances. Now you essentially have no money in the deal. So everything you continue earning from that point forward becomes more like an infinite return, because it can't be measured because you have no money in the deal. So that's also a great model. We kind of do a mix as much as possible of those two strategies.
Yeah, I love that. I mean, if we can get those, we do those all day long, because the investor gets either all, like you said, infinitive, or at least a majority of their money back. They still get cash flow. Now
Yes.
they're 30, 40% cash on cash. They take that same money and put it in a new deal, and they now getting a return on that money. And like the combined cash on cash of that same, whatever, $100,000 is fairly enormous at this point over time, which is really cool. Do you use your IRA for investing?
I have. So for many years, I used a self-directed IRA, and I wish more people knew that this was an option. But if you have an old 401k or an old IRA or Roth or whatever it may be, you can convert that to a self-directed, which instead of investing in stocks, bonds, mutual funds, and Fidelity and Schwab and all the traditional stuff you see out there, you can get more into actual real estate investing, note lending, investing in businesses, gold, silver. There's all these things that, if you're tuned into that and you understand the impact and value behind investing in those, may make a lot of sense for you, but of course not for everyone. But yeah, I certainly have in the past.
That's great. Have you been affected by the UBIT tax in the IRA at all, or is not really relevant?
So my personal philosophy with this is I made investments with my self-directed IRA because it was a pre-tax account in things that were not tax advantaged themselves. So I didn't actually do syndications with depreciation and UBIT and all that. I did some note lending and a couple funds that like paid interest basically. So there's no tax advantage to that. You just pay taxes on it. So that's what I did.
That's great. That's great. That's awesome. So, all right. So you've done a lot of investing, and you've done some single family house investing, and you've seen a lot of things. Have you ever had any kind of aha moment that you're like, wow, that's amazing. And so what was that?
There's been so many aha moments. I mean, we talked about going passive with syndication versus single family. That was obviously probably the biggest. Another one I would point out is I read a book called Tax-Free Wealth by Tom Wheelwright.
Great book.
And just to understand, and there's a new edition of that too, since our tax change
Yep.
that just happened. And just to understand, you can structure legally your situation potentially to pay zero in taxes. And, I never got into real estate for tax advantages or for any type of tax purpose, but it ended up over time making this huge impact to see that you really can pay no tax legally at a federal and state level. So I don't know how much money that book has saved me, but it was definitely one of those like, holy crap, this stuff's real. And so, yeah. That was
Yeah, I mean, Tom's philosophy is not that they can save money, but how can they save in taxes? And their goal is to basically get down to 0%. So I've actually worked with them, and they're not cheap to work with, but I will tell you, and I agree with you, that book paid for itself. I'd say that investment paid for itself. They're just so creative, and they're so custom to whatever your situation is, because they really try to understand your situation.
Yes.
And then they figure out what they can do to essentially approach zero on your taxes. And it's a really fresh approach to taxes. I mean, typically for years, the CPA has always been reactive more than proactive.
Yes. Yes.
And while they do taxes, their main model is simply advising you on your tax strategy and working with your CPA on that. So that was pretty amazing. I mean, Tom really knows his stuff, and he's not afraid to read the tax code. So no, that's anything else that was kind of a big aha moment for you.
Well, I mean, just to piggyback on that, what you just alluded to is also a critical thing for real estate investors. Find a CPA firm, whether it's Tom or anyone else, that specializes in what you do specifically. That really made a big impact when I worked in the oil industry and I was working overseas. The current CPA I had no idea that I was exempt from a lot of taxable income. It was crazy. Right. I know. And then as I kind of retroactively looked back, and I thought, wait a second, like no one else was really paying taxes there legally, but I was. I had to amend, and just the lessons learned of finding a competent CPA that focuses on what you focus on is critical.
That's a big aha moment, that the tax law, Tom always makes the point that no CPA actually ever reads a tax law, because one size does not fit all. So that's a pretty big aha moment for me, that holy cow, there's stuff in the tax code I've never even heard of before.
Yep.
And people like Tom have.
Yep.
And they may not know it off the top of their head. They might say, hey, let me look into this and get back to you. And then literally they get back to you. So that was for me a big aha moment also. And it, like you said, it varies, right? You could be a dentist or a doctor investing passive. Your situation is going to be different than yours or mine.
Yes.
And having that person figure out how to offset, active income with the passive losses, it's just magic. It's magic. So
it is. And it's not my expertise individually. So again, leverage
mine either.
Expertise. Yeah. But it can be incredible for you. Yep.
Now, what advice do you have for someone, who's maybe in your shoes, right? Relatively good income and ability to save some money and make some investments, typically in the stock market, or maybe they own a piece of real estate, and they're like, holy cow, Travis has been able to essentially quit his job or, cover his living expenses entirely by passive income. Mm-hmm. What advice do you have for that person to do what you've done?
I would say two things to start with. Start with trying to find a why, trying to find a reason. Why do you not want to work a job you don't like, till the day you die? Or what are you passionate about? What are some things you wouldn't mind spending a lot more of your time on if you had that opportunity? I just don't think a lot of people focus on why, and it's more of maybe a sheep mentality of, everyone else is working, I guess I'll work, and no one else likes their job, I guess I don't have to have one that I like too. And so start with your why and get a budget down, understand where your money's going.
Okay. Hold on, before you get to the budget, that's good stuff. So understand your why. Why is that important? What difference does it make that you understand that?
That's going to be your biggest motivator to continue going. If you make a why, like, well, I want to make $10,000 a month passive income, and that's it, that you don't even know why you're doing it, then, the first hurdle that comes up that kind of kicks you and gives you a hard time, you're going to go, it's not worth it. I thought I wanted that. I guess not, whatever. But if you have a real passionate why, spending more time with your kids, or putting your kids through college, whatever it may be, everyone obviously is different. That's going to keep motivating you to move forward as you hit roadblocks and hurdles along the way. That's why I think that's important.
Okay, good. I love that. All right, and then you were talking about budget.
Again, self-awareness. Like, okay, it doesn't matter if you earn 20,000 a year or 200,000 a year. Where's your money going? How much is going into just taxes? How much is going into living? Do you need 3 or 4 cars? Could you deal with 1 or 2? There's just always something to look at on a financial spreadsheet. I've always kept one, by the way, even from high school, which is crazy. When I was doing like lawn mowing jobs, I knew where all my money was. And it's just helpful, right? It's just, it helps you realize that, hey, I could cut 200 a month if I just didn't do that, which I don't even really care about, right? I'm just buying food on the way home at, fast food or something. So.
All right. So your why and your budget. Now, I think the other thing you alluded to earlier on this note is what's advice for someone to get started is, I think it's fairly important that you pick and select the right sponsor to invest with. And that you said earlier, when your first deal wasn't maybe the best sponsor, it doesn't sound like it was a nightmare, but maybe it wasn't a pro forma kind of investment.
Yeah.
What is your advice on finding and vetting a good sponsor to invest with?
That's a great question. Very open-ended question, but typically, I guess I'll just talk in general terms, try to find a group that, one, you align with in philosophy, right? So if you believe that there's some markets in Texas and Florida that are really growing that you think are great markets to be in, maybe don't look at deals of a group that's doing investing in Maine, when you know nothing about that market and it doesn't resonate, or California or something like that. So first, try to find a group that matches up well to you. For me personally, I wanted monthly distributions. For me, that was important, especially getting started, just because that was my income, so do I want to be paid once a quarter or once a month? And then they were investing in markets that I also believed in myself. They did have a track record. It was more than just a single individual on the team, right? They had an actual team. They had the experience. I mean, they could show me, here's, 5, 6 deals that we completed, there's our results and numbers. And then as they had a new one come up, I felt a lot more comfortable making that investment. And as I did allude to earlier, I'd say 2 or 3 total investments with groups that were brand new. Maybe they'd done 1 or 2 deals, something like that. The beauty of it, the thing that I really learned, was the deal itself came through. We actually ended up hitting more or less the pro forma. We didn't execute the business plan as intended, but they ended up not being able to distribute, and things kind of went south. Well, they just put it up for sale, and they were able to exit the investors at a profit. So I do believe in the underlying asset itself of multifamily. That's kind of the beauty of it.
So this is good stuff. And then how can people typically find these kind of sponsors?
That's also a good question. So there's different regulations out there between a 506B and a 506C. So high level there, a 506C, you can generally solicit. You can put that out there to the world in any form or fashion, because you can only take accredited investors, high net worth individuals with $1 million net worth, excluding their primary residence, 200,000 a year income if they're individual, 300,000 for a married couple. So those are a lot easier to find, in my opinion, because they're advertising those, right? The other thing is 506B, I think, is what a lot of groups are doing. So they can't generally solicit, but they can still advertise like their business as a whole, like who they are and what they do. You find a lot of these groups through real estate meetups, through seminars and things like that. I personally am I'm a huge fan of doing that kind of stuff. I recognize not everybody is, and yes, it costs a little bit of money, but I'm a big networker and I just love attending stuff like that. So if you have the ability, or something's coming your way through your town, go to it, go spend a couple $100 or whatever it may be, and go network with people. And so a lot of the investments we do, they start with a word of mouth referral. I'll hear someone at a conference say, hey, have you checked out this group? You ever heard of them? I've been investing with them in 3, 4 deals, and I think they're pretty awesome. Things have gone, it's a great team. That's usually how it starts. And then I'll kind of start my due diligence from there. And, a few months later, usually make an investment with them if everything checks out. So.
It's good, Travis. It's great. How can people connect with you?
Yeah, email is usually the best way. I'm always traveling and doing something. So Travis at ashcroftcapital.com is my email. You can find me too on LinkedIn and Facebook and things like that. It's Travis Watts. My last name is Watts. So reach out in any way you can. And I always like talking real estate, just like this, right? With doesn't have to be an agenda to it, but this is just what I'm passionate about, what I love doing. So definitely reach out.
Travis, it's great having you on the show and really inspiring our passive investors to follow your footsteps of, achieving financial freedom with passive investment. So thanks for being on the show today.
Thanks so much, Michael. Appreciate it.
All right, if you are like Travis and has some money to invest, okay, please really take a look at multifamily syndications. I cannot emphasize this enough. Listen to this, obviously, podcast, but also episode 186 with Spencer Hilligoss, 181 with Jan Larson, and 174 with Ryan McKenna, okay? This is not a one-off thing, guys, okay? This is something that is real, something within 3 to 5 years you can literally replace your income, cover your living expenses, and you are done as a passive investor, and it's super, super cool. If you want to check us out at Nighthawk Equity, you can join our investment club, which is nighthawkequity.com/join, or just go to nighthawkequity.com and click the join button. You'll fill out a very, very short form, schedule a call with us so we can get to know each other and make sure that, as Travis talks about, there's an alignment there, the kind of deals that we're doing and what you're looking for is the cash flow appreciation, a little bit of both, what kind of markets, those kind of questions. So go to nighthawkequity.com/join. I would look forward to talking with you. So anyway, so if you are a passive investor or a potential passive investor, really educate yourself. Such a powerful way to build cash flow, long-term wealth by investing in multifamily syndications. It is by far the best investment vehicle on the planet is US-based multifamily syndications. So excited about that. So thanks for being me on the show, and we'll catch you next episode.